A quick hack to our listeners, look at the profit margin. What is profit margin? Profit margin is the net income divided by revenue and multiplied by 100. A higher profit margin means a company is efficient at making money. Hello, welcome to the Nigerian Investors Podcast, the unofficial podcast that tracks and reports on the activities of the Nigerian boss. My name is Mudi, and with my colleague Aye, we will be hosting this podcast. TNI Podcast is dedicated to stimulating a renewed enthusiasm among the general population with regard to the activities of the Nigerian Stock Exchange. Ultimately, the goal of TNI is to see that many Nigerians from all walks of life, both at home and in the diasporas, become active participants on the floor of the Nigerian Stock Exchange. Before we go further, we would like to place on record TNI Podcast is solely for educational purposes and not a replacement for professional financial advice. Let's begin. Welcome to the Nigerian Investor, the podcast that simplifies investing and finance for everyday Nigerians. I'm your host, Mudi.
And I'm Aye. Today we're breaking down one of the most important financial statements every investor and business owner should understand, and that is the income statement.
If you have ever wondered, is this company actually making money? The income statement is where you will find the answer. It shows how much a business earns, how much it spends, and whether it is profitable.
And it's not just for companies too, Moody. If you're managing a small business, investing in stocks, or even tracking your personal finances, knowing how to read an income statement can help you make smarter financial decisions.
That's true. Whatever that involves finance, income statement is very important, even in your daily life. By the end of this episode, you will understand what an income statement is, key terms like revenue, expenses, and net income, and how to use it to make better investment and business decisions.
Let's get into it.
That's right, Aye. The income statement, also known as the profit and loss statement, provides a summary of a company's revenues, expenses, and profit over a specific period of time. Aye, why don't we start by breaking down some of the key components of an income statement?
Absolutely, Moody. Let's start with revenue. Now, revenue is the total amount of money a company earns from its business activities, such as sales of goods or services. It's often referred to as the top line because it appears at the top of the income statement. It's the first line item you're going to see on the income statement.
Right. And it is important for investors to look at revenue growth over time. Consistent revenue growth is usually a good sign that the company is expanding and increasing its market share. Moving on, what is the next key item, Aye?
Next, we have cost of goods sold, or as we approximate it, COGS. Now, this represents the direct cost associated with producing the goods or services that the company sells to generate revenue. These costs can include raw materials, direct labor, or manufacturing expenses. Subtracting cost of goods sold from revenue gives us gross profit.
Gross profit is a critical measure because it indicates how efficiently a company is producing its goods or services. The higher the gross profit, the better. Now, Aye, what can you tell us about operating expenses?
Operating expenses are the costs required to run the company's day-to-day operations. This includes things like salaries, rents, utilities, and marketing expenses. After deducting operating expenses from gross profit, we get the operating income, also known as operating profit of the company.
Exactly, Aye. Operating income shows us the company's profit from its core business operations, excluding any income from non operational sources. Let's not forget about interest expense and taxes, Aye.
Of course, interest expense is the total cost incurred by the company for borrowed funds. and taxes are government levies on companies' earnings. After accounting for this, we reach the net income, or as we call it, the bottom line, which represents the company's total profit after all expenses have been deducted.
Why should investors care about all this? Now, let's talk about why this matters to you as an investor.
If a company constantly makes profits, that's a green flag, right? But if it's always making losses, you need to ask why before investing your money. Not all companies that are making losses are bad, but it's important to understand the why of why that company is making losses.
That's true. Another thing you also need to look out for is the potential for growth. Compare income statements over time. Is revenue growing? Are expenses rising too fast? A company with increasing profit is usually a solid company.
Companies with strong profits can also pay dividends to their shareholders. They can also reinvest some of the money they make in growth, and often this leads to higher stock prices.
That's very correct. That's very correct. There are so many examples on the NGS. We can start naming them from now till tomorrow, and we're not going to finish the list. A quick hack to our listeners: look at the profit margin. What is profit margin? Profit margin is the net income divided by revenue and multiplied by 100. A higher profit margin means a company is efficient at making money.
So there you have it, our listeners, the income statement decoded. Remember, we said in our last episode, we talked about the balance sheet and how it only measures the performance of a company at a moment in time. The income statement, however, can measure the performance of a company over a period of time. Like Moody has said, sometimes 3 months, sometimes a year. What you're looking at when you're looking at the income statement is you're looking at, for the business the company is doing, how much revenue have they generated for the goods they sell or the services they render. For a bank, they render the service of giving out loans. For companies like Dangote Sugar, Dangote Cement, they sell products to the market. They generate revenue by doing that. They then subtract different layers of cost, from cost of goods sold to operating expenses down to financial costs for borrowed funds and taxes they pay to the government. Whatever they get to keep is called the net income, which Moody has explained. You can calculate what margin that net income is relative to the revenue the company generates. So it's very important to understand this and you get a clear picture of what the company is generating, how much the company gets to keep, and how much the company has spent in expenses.
That's good. Thank you so much, Aye, for that elucidation. Whether you're running a business, investing in stocks, or trying to manage your own money better, understanding this financial statement is a game changer.
If you found this episode helpful, don't forget to subscribe, leave a review, and share it with someone who needs to hear this.
For more financial insights, follow the Nigerian Investors Podcast on social media. We hope we've been able to demystify the almighty financial statement so far. Watch out for the next episode where we'll talk about cash flow.
Until next time, folks, stay informed, stay empowered, and keep investing wisely.
Thank you for listening to another episode of the favorite podcast that brings insight to the Nigerian stock market. We hope you enjoyed today's episode. To get more episodes like this, follow us on YouTube, Twitter, Facebook, Instagram, TikTok, Amazon Music, Apple Podcasts, Spotify Podcasts, as well as on our website. All this information is available in the show note below this episode. Until we bring you another episode your way next week. Bye for now. Mudi and Aye podcast is executive produced by Mudi. This episode was edited by Rona at Rock Quarry Village Studio.